The trade that hurts you most often doesn't begin with a bad chart. It begins with the quiet moment you decide you have seen enough. Long before the market proves anything, your mind has already reached a verdict. That decision feels disciplined because you can point to reasons, patterns, and signals. Yet the damage usually starts there, in the small distance between what you expect to happen and what the market has actually confirmed. Pay attention to how often urgency disguises itself as preparation. You study the setup, recognize familiar conditions, and convince yourself that waiting will only reduce the opportunity. The fear is rarely about missing profit. It is about watching the market move without you and feeling that you understood it too late. That feeling pushes your hand toward the order button long before the market has revealed whether your idea deserves capital. This is where the confirmation trap quietly takes control. It does not force reckless trades. It rewards careful analysis just enough to make premature action appear reasonable. You begin collecting evidence that supports your expectation while dismissing the information that demands patience. Every candle that leans in your direction strengthens your confidence, even when the structure you originally needed has not yet appeared. The market has not confirmed your trade. It has only confirmed your desire to be early. The irony is difficult to accept because being early often looks intelligent. You catch better prices. Your entries appear bold. Occasionally the market rewards that behavior, and those occasional rewards become powerful teachers of the wrong lesson. A handful of successful early entries can create a habit that survives long after the conditions that produced them have disappeared. Over time, confidence shifts away from reading the market and toward defending your prediction. Notice what experienced traders protect more carefully than their opinions, their timing. They understand that analysis has value only when it is matched with evidence that the market itself is beginning to agree. Until then, every position carries an invisible cost. It ties up attention, drains emotional discipline, and makes every small fluctuation feel more significant than it really is. The earlier you enter without confirmation, the more uncertainty you volunteer to manage. So before looking for another indicator or another pattern, there is a different habit worth examining. Watch the moment when conviction starts to outrun observation. Notice when you stop asking what the market is doing and begin asking how soon it will validate your idea. That shift is subtle, but it changes every decision that follows. And once you can recognize it, the question is no longer whether confirmation matters. It becomes how to distinguish genuine confirmation from the convincing illusion that has trapped traders for generations. A trade idea is not the same as permission to trade. That distinction seems small until you begin measuring its cost. The chart can look attractive, your analysis can be consistent, and your reasoning can be sound, yet none of those conditions require immediate action. The market does not reward preparation by itself. It rewards timing that matches what price is actually doing. The mistake is often hidden in the sequence. You analyze first, form an expectation second, and then begin searching for a reason to enter. Without realizing it, execution becomes an extension of your opinion instead of a response to fresh evidence. The order is backwards. Analysis should create a watch list of possibilities. Execution should wait for the market to narrow those possibilities into one decision. Think about what an entry really represents. It is not simply buying or selling. It is the moment you exchange uncertainty for risk. Once capital is committed, every movement against you carries a financial consequence. Because of that, an entry should never answer the question, could this move? It should answer a much stricter one. Has the market done enough to justify participation? Those are very different standards. This changes the role of confirmation completely. Confirmation is not there to make you feel confident. Confidence is unreliable because it comes from your own judgment. Confirmation comes from the market's behavior. It is evidence that price has begun acting in a way that supports your original idea instead of merely allowing it. That evidence may arrive through a level holding after being tested, a breakout that attracts continued participation instead of immediate rejection, or a trend that proves capable of sustaining itself rather than hesitating at the first obstacle. The exact pattern matters less than the principle. You are waiting for behavior, not for reassurance. Waiting also improves the quality of the information available to you. Every additional candle reveals something the previous one could not. It shows whether buyers or sellers continue defending their position. It shows whether momentum expands or fades. It shows whether the move attracts commitment or loses interest almost immediately. By delaying execution until new information appears, you are not becoming slower. You are making your decision with a larger sample of evidence. This requires replacing the habit of asking, "Can I enter now?" with a better question. What still needs to happen before this trade earns execution? That shift changes your relationship with the chart. Instead of searching for reasons to act, you begin identifying the conditions that must exist before action is justified. The market is no longer expected to agree with your analysis immediately. It must first demonstrate that it is moving in the direction your analysis anticipated. One practical way to develop this discipline is to define your execution criteria before the setup appears. Decide in advance what price behavior will qualify as sufficient evidence. If those conditions are absent, no amount of excitement, speed, or apparent opportunity changes the decision. You are not delaying because you hesitate. You are delaying because your rules have not yet been satisfied. Over time, this transforms execution from an emotional event into a repeatable process. The entry stops being the reward for finding a good idea. It becomes the result of the market meeting your conditions. That difference seems almost invisible when looking at a single trade, yet it quietly changes the quality of every decision that follows. And it also raises an uncomfortable question about what is really being purchased when you choose to enter too early. A trade can move exactly as you expected and still produce a poor result. That is one of the least appreciated realities in trading. Direction alone does not determine performance. Timing changes the numbers behind every position, and the numbers decide whether an edge survives over hundreds of trades. An early entry often looks attractive because it promises a better price. On the surface, buying lower or selling higher appears to improve the opportunity, but price alone is only one variable. Every entry creates a relationship between the entry point, the stop, the target, and the probability of reaching the target. Change one variable, and the others change with it. Suppose the market has not yet provided enough evidence that the move is underway. If you enter anyway, your stop usually has to sit farther away to survive normal fluctuations. A wider stop increases the amount of risk attached to the same idea. If you keep your position size unchanged, you expose more capital. If you reduce your position size to maintain the same risk, your potential return becomes smaller. Either way, the mathematics has already shifted before the market has gone anywhere. There is another cost that receives far less attention. Time inside a trade is also exposure. Every extra candle before the move develops creates another opportunity for ordinary price movement to interfere with the position. The longer you remain exposed before momentum begins, the greater the chance that random fluctuations will reach your stop without proving your original idea wrong. You are not simply risking direction. You are increasing the number of opportunities for chance to affect the outcome. This changes the probability of success in subtle ways. Imagine two traders with the same market view. One waits until price demonstrates that the move has begun. The other enters beforehand. They may both be correct about direction, yet they are not trading the same probability. The earlier trader accepts more uncertainty while receiving no guarantee of additional reward. Over a single trade, the difference may seem insignificant. Across a large sample, small reductions in probability accumulate into measurable differences in performance. That is why expectancy matters more than individual outcomes. Expectancy is built from the combination of win rate, average gain, and average loss. Entering too early can weaken all three at once. A larger stop increases average loss. Lower confirmation reduces the chance of success. Extra exposure may force smaller positions or less efficient reward to risk relationships. None of these changes need to be dramatic. Even slight deterioration, repeated consistently, can erase what once appeared to be a profitable approach. When you evaluate an entry, Ask a mathematical question rather than an emotional one. Is entering now improving the statistical quality of this trade, or simply increasing the amount of uncertainty attached to it? If waiting removes a portion of uncertainty while preserving most of the opportunity, then waiting has created value even if the entry price is less favorable. This is why experienced traders rarely measure an entry by how close it was to the bottom or the top. They measure it by whether the numbers behind the trade became stronger after execution. A slightly worse price attached to a stronger probability is often the more valuable transaction. The market does not reward precision for its own sake. It rewards decisions that improve expectancy over time. And that raises another question. If timing changes the mathematics of a trade so dramatically, what exactly is the market revealing before those probabilities begin to improve? That answer lies not in the numbers themselves, but in the way price behaves before a meaningful move begins. The market rarely changes direction with the clarity traders hope for. Before a meaningful move develops, price often appears uncertain, inconsistent, or even contradictory. It pushes higher only to retreat. It breaks a level and quickly returns. It pauses where momentum was expected to accelerate. None of this is random noise. It is part of the process through which the market reveals whether buying or selling interest is strong enough to sustain movement. Price does not travel because a pattern has appeared. It travels because one side continues accepting transactions while the other gradually loses control. That shift is not announced in a single candle. It develops through repeated behavior. A level that continues to hold after being challenged tells a different story than one that fails on the first test. A breakout that attracts continued participation carries different information than one that immediately reverses. The important message is not the event itself. It is the market's response after the event. This is why the first move is often less informative than the reaction that follows it. A sudden push through resistance may look decisive, but if buyers cannot maintain that progress, the breakout has revealed weakness rather than strength. The opposite is equally true. A temporary move below support means very little if selling pressure disappears and price is quickly accepted back above that area. The market is constantly testing its own decisions. Watching those tests tells you far more than reacting to the initial movement. Every test answers a practical question. Are participants willing to continue doing business at these new prices? If the answer is yes, price tends to build upon the move instead of abandoning it. If the answer is no, the market often returns to where agreement previously existed. This repeated search for acceptance explains why strong trends rarely begin as clean, uninterrupted advances. They first establish evidence that the move can survive pressure from the opposing side. When you begin looking at price this way, confirmation becomes less about identifying a pattern and more about interpreting behavior. Instead of asking whether the chart matches something familiar, ask whether the market is consistently supporting its own recent actions. Is every challenge being rejected, or is each attempt losing commitment? Is price expanding with follow-through, or simply reaching new levels without attracting continued participation? These observations reveal whether movement is being sustained or merely explored. This approach also changes how you interpret waiting. Waiting is not standing aside because nothing is happening. It is allowing the market enough time to demonstrate whether its first move deserves to be trusted. Early movement often reflects possibility. Repeated behavior reflects commitment. The difference is subtle, but it separates temporary activity from directional intent. You will notice that reliable moves tend to leave a trail of evidence, rather than a single dramatic signal. One observation supports the next. A defended level is followed by continued acceptance. Continued acceptance is followed by expanding movement. Each step strengthens the case, because the market keeps behaving consistently instead of asking you to rely on prediction. The decision becomes grounded in observable behavior rather than isolated events. Once you recognize that price is constantly revealing the quality of its own movement, another challenge naturally appears. The market may provide evidence, but you still have to decide when that evidence is sufficient to justify action. Knowing what price is doing is only part of the task. Knowing how to make decisions from that information is where the next layer begins. A forecast and a trading decision are not the same thing, yet they are often treated as if they cannot be separated. You study the chart, form an opinion about where price is likely to go, and almost immediately feel pressure to act on that opinion. The decision appears to follow naturally from the prediction. In reality, they serve two different purposes. One attempts to understand the market. The other determines whether capital should be placed at risk. The problem begins when a prediction is mistaken for permission. A market view is only a possibility, regardless of how convincing it appears. It does not carry authority simply because it is supported by careful analysis. The market is under no obligation to behave according to your expectation. That is why experienced decision making begins with a simple distinction. You are allowed to have an opinion long before you are required to make a commitment. Think of every market idea as a proposal rather than a conclusion. A proposal deserves attention, but it has not yet earned action. This changes the sequence of your thinking. Instead of asking, "Am I right?" you begin asking, "Has enough happened to justify treating this idea as executable?" Those are fundamentally different questions. The first seeks validation for your analysis. The second seeks justification for your decision. This shift protects you from a common weakness in trading decisions. A correct prediction can still produce a poor decision if it was made before the available evidence supported action. Likewise, a trade that loses money can still represent a sound decision if it was taken only after the required conditions were satisfied. Once you separate prediction from permission, you stop judging decisions by outcomes alone. You judge them by whether they were made under the right circumstances. This way of thinking also creates flexibility. Markets evolve while your analysis remains fixed unless you allow it to change. If new information appears that weakens your original idea, you are free to revise your view because you have not confused your opinion with a commitment. The decision remains open until the evidence reaches your predefined standard. As long as capital has not been committed, changing your mind is not inconsistency. It is an appropriate response to changing conditions. Notice how this improves clarity during uncertain periods. Instead of feeling compelled to interpret every movement as either confirming or denying your forecast, you simply continue observing. Some developments strengthen the proposal, others weaken it. Neither demands immediate action. Your role is not to defend an idea. Your role is to determine whether the idea has matured into a decision that deserves risk. A practical habit follows naturally from this approach. Before every potential trade, separate your notes into two parts. In one part, write your market view. In the other, write the specific conditions that would authorize execution. Never allow the first list to substitute for the second. A strong opinion cannot replace missing evidence. By keeping these two decisions separate on paper, you train yourself to keep them separate in practice. Over time, this discipline changes the quality of every choice you make. You stop measuring success by how often your forecasts prove correct and start measuring it by whether you consistently waited for permission before acting. The market becomes less of a place where you defend predictions and more of a place where you respond to observable conditions. That distinction is essential, but it raises another challenge. Even when you know how to separate opinion from action, maintaining that standard trade after trade depends on something quieter than analysis or decision-making. It depends on the routines you build before the market ever begins to move. Patience is often described as a personal quality, but in trading it is more accurately the result of a routine. If waiting depends on how you feel in the moment, it will eventually fail. Every trading session presents new prices, new opportunities, and new temptations. Relying on self-control alone means asking yourself to solve the same problem repeatedly under pressure. A routine removes that burden by making important decisions before emotion has a chance to interfere. This is why experienced traders spend as much time preparing for trades they may never take as they do studying the ones they eventually enter. Preparation is not only about finding setups. It is about deciding in advance what deserves attention and what does not. When the market opens, the purpose of your routine is no longer to search endlessly. It is to compare what is happening with standards that already exist. A written process changes the nature of execution. Instead of asking yourself whether a chart looks attractive, you begin checking whether specific conditions have been satisfied. Each requirement acts like a filter. If one condition is missing, the process pauses automatically. Nothing dramatic happens. You simply continue observing because your own routine has already defined what qualifies and what does not. This approach also reduces unnecessary decisions. Every decision consumes attention, and attention is limited. If you repeatedly debate whether to take marginal trades, you gradually exhaust the same judgment you will need when a high-quality opportunity finally appears. Good routines conserve decision making by removing questions that should never be answered in real time. The fewer unnecessary choices you face during the session, the clearer your thinking remains when an important one arrives. There is value in creating small delays that separate observation from execution. That delay does not need to be long. It may be as simple as reviewing your checklist one final time, reading your criteria aloud, or waiting for the current candle to complete before placing an order. These actions may appear insignificant, but they interrupt impulsive behavior by forcing your routine to take one final step before capital is committed. Consistency also depends on reviewing what your routine produces. At the end of a session, do not ask only whether your trades made money. Ask whether every trade passed through the same process. A profitable trade that ignored your routine teaches the wrong lesson. An unprofitable trade that followed every step still strengthens the habit you are trying to build. The routine is the part you control. The market's outcome is not. Over time, these repeated actions begin shaping your behavior without requiring constant effort. You no longer feel as though you are resisting the market every minute. Instead, your routine quietly guides your attention toward qualified opportunities and away from everything else. Waiting becomes less of an emotional achievement and more of a normal part of how you operate. This is why professional habits often appear uneventful from the outside. They are built from ordinary actions performed the same way, session after session. There is no single habit that transforms results. There is only a collection of small, repeatable behaviors that gradually remove inconsistency from the decision process. Even with a strong routine, however, one challenge remains. A trade can still begin earlier than it should, and when that happens, the consequences do not end with the entry itself. They continue into every decision that follows while the position is open. A trade does not become easier to manage simply because the analysis was correct. In fact, the quality of trade management is often decided before the position is ever opened. An early entry changes the environment you must manage. It places you into uncertainty sooner, and from that moment forward, every decision becomes more demanding than it needed to be. The market rarely moves directly from your entry to your target. It expands, pauses, retraces, and tests levels along the way. Those movements are a normal part of price behavior. But when you enter before the market has truly begun its move, you spend more time exposed to those ordinary fluctuations. The trade has not yet reached the phase where momentum is doing the work. Instead, you are managing through the stage where uncertainty still dominates. This changes the meaning of every price movement. A small pullback that would be insignificant after confirmation can feel threatening when it occurs immediately after an early entry. A pause that is perfectly normal within market structure now appears to challenge your position because your trade arrived before the market had clearly committed. The chart may not have changed much, but your management decisions become more difficult because your position is experiencing more uncertainty than necessary. As a result, traders often begin solving problems that would never have existed with better timing. Stops are widened to avoid being shaken out. Stops are tightened after minor reactions because confidence fades. Profit targets are reduced out of concern that the move may fail before reaching its objective. Some traders exit completely, only to watch the anticipated trend develop without them. None of these decisions happen in isolation. They are responses to conditions created by the entry itself. Good trade management depends on allowing the original plan enough room to unfold. That becomes much harder when the trade begins before the market has established direction. Instead of managing an advancing position, you spend valuable attention managing uncertainty. The position demands constant interpretation because the market is still deciding something you already assumed had been decided. This is why entry quality and trade management cannot be separated. A stronger entry does not guarantee an easier trade, but it reduces the number of unnecessary decisions required afterward. When price has already demonstrated commitment, routine pullbacks occur within a more established context. You are managing movement that has already shown evidence of continuation rather than hoping it eventually will. One useful observation is to notice how often management changes after entry. If you regularly find yourself adjusting stops, reconsidering targets, or questioning the trade within a short time of execution, the issue may not be your management skills at all. It may be that your entry consistently places you into the position before the market has done enough to support it. Improving management sometimes begins by reducing the situations that require constant management in the first place. The goal is not to eliminate every difficult decision. Markets will always require judgment while a trade is active. The goal is to avoid creating avoidable complexity. Every unnecessary adjustment increases the chance that your final result will reflect reactions to short-term movement rather than the original quality of the opportunity. That naturally leads to another question. If early entries create so many avoidable management problems, why do they continue to happen so often? The answer is not found in trade management itself, but in the recurring mistakes traders repeatedly mistake for genuine confirmation. Not every sign of strength deserves to be called confirmation. The market constantly produces movements that appear convincing for a brief moment, only to lose their significance a few candles later. The mistake is not that these signals exist. The mistake is treating isolated events as complete evidence. A single observation rarely tells the whole story. One of the most common errors is believing that a breakout confirms direction simply because price has crossed an obvious level. Crossing a level only answers one question: price has moved beyond a boundary. It does not answer the more important question of whether the market intends to remain there. Without continued acceptance above resistance or below support, a breakout is simply movement. It has not yet become commitment. Another mistake is confusing speed with conviction. A large candle often creates the impression that buyers or sellers have taken complete control. Fast movement attracts attention because it feels decisive. Yet rapid price changes can occur for many reasons, including short-term imbalances that disappear almost as quickly as they appeared. If the move cannot attract continued participation, its size becomes far less meaningful than it first appeared. Indicators create a different kind of misunderstanding. When several indicators begin pointing in the same direction, the trade can appear fully validated. But indicators are built from price. They often agree because they are responding to the same underlying movement through different calculations. Agreement between indicators does not automatically mean the market has confirmed the idea. It may simply mean several measurements are describing the same incomplete event. Volume is often misunderstood in a similar way. Increased activity attracts attention because it suggests interest. But volume alone cannot tell you whether that interest is building a sustained move or exhausting one. Heavy participation near the end of a move may signal something entirely different from heavy participation at the beginning. Without understanding how price responds after increased activity appears, volume becomes another observation taken out of context. News can create perhaps the strongest illusion of confirmation. A major announcement often produces immediate movement, making the direction seem obvious. Yet the first reaction frequently reflects urgency rather than lasting agreement. Markets do not always continue in the direction of the initial response. Sometimes the most important information comes after the first wave of activity, when price either maintains the move or quietly begins reversing it. The headline starts the process. It does not complete it. The common thread through all of these mistakes is simple. Traders often mistake evidence that something has happened for evidence that something is continuing. Those are different questions. Markets can move briefly without developing into trends. They can break levels without accepting new prices. They can produce impressive candles without sustaining momentum. Confirmation is not the first visible event. It is the consistency of behavior that follows. A useful habit is to examine every apparent signal with one additional question. What evidence is still missing? That question prevents a single observation from carrying more weight than it deserves. It encourages you to look for continuation instead of reacting to appearance. Over time, you begin recognizing that the strongest trades are rarely supported by one dramatic event. They are supported by several pieces of evidence that remain consistent with one another. Learning to avoid these false signals is an important step, but recognizing mistakes is not the same as becoming a better trader. Avoiding errors prevents unnecessary losses. Lasting improvement comes from something deeper, the gradual transformation of how you evaluate your own progress from one trade to the next. In the early stages of trading, progress is often measured by one simple question. Was I right? It seems like a reasonable standard. If the market moved in the direction you expected, your analysis appears successful.